Hello, good day everyone. Good day classmates and good day Doc Rotzin. This time I am going to discuss my report which is all about financial management theories. Okay, the first theory that I'm going to discuss is the agency theory. Agency theory is a principle that is used to explain and resolve issues in the relationship between business principals and their agents. Most commonly, that relationship is the one between shareholders as principals and company executives as agents. An agency, in broad terms, is any relationship between two parties in which one, the agent, represents the other, and the principal in a day-to-day transactions. The principal or principals have hired the agent to perform a service on their behalf. Principals delegate decision-making authority to agents because many decisions that affect the principal financially are made by the agent. Differences of opinion and even differences in the priorities and interests can arise. Agency theory assumes that the interests of a principal and an agent are not always in alignment. This is sometimes referred to as the principal-agent problem. The principal-agent problem is a conflict in priorities between a person or group and the representative authorized to act on their behalf. An agent may act in a way that is contrary to the best interest of the principal. The principal-agent problem is as varied as the possible roles of the principal and agent. It can occur in any situation in which the ownership of an asset or a principal delegates direct control over the asset to another party or agent. For example, a home buyer may suspect that a realtor is more interested in a commission than in the buyer's concerns. An agent is using the resources of a principal. The principal has entrusted money but has little or no day-to-day input. The agent is the decision maker but is incurring little or no risk because any losses will be borne by the principal. Financial planners and portfolio managers are agents on behalf of their principals and are given responsibility for the principal's assets. Agency theory addresses disputes that arise primarily in two key areas: a difference in goals or a difference in risk aversion. For example, a company executives with an eye toward short-term profitability and an elevated compensation may desire to expand a business into new high-risk markets. However, this could pose an unjustified risk to shareholders, who are most concerned with long-term growth of earnings and share price appreciation. Another central issue often addressed by agency theory involves incompatible level of risk tolerance between a principal and an agent. For example, shareholders in a bank may object that management has set the bar too low or on loans approvals, thus making on too great a risk of defaults. Various proponents of agency theory have proposed ways to resolve disputes between agents and principal. This is termed as reducing agency loss. Agency loss is the amount that principal contents was lost due to the agent acting contrary to the principal's interest. Chief among these strategies is the offering of incentives to corporate managers to maximize the profits of their principals. The stock options awarded to company executives have their origin in agency theory. These incentives seek a way to optimize the relationship between principals and agents. Other practices include tying executives' compensation in a part to shareholders' return. These are examples of how agency theory is used in corporate governance. These practices have led to concerns that management will endanger long-term company growth in order to boost short-term profits on their own pay. This can often be seen in budget planning, where management reduces estimates in annual budgets so that they are guaranteed to meet performance goals. These concerns have led to yet another compensation scheme in which executive pay is partially deferred and to be determined according to long-term goals. In continuation, uh, these solutions have their parallels in other agency relationships. Performance-based compensation is one example. Another is requiring that a bond is posted to guarantee delivery of desired result. And then there is the last resort, which is simply firing the agent. So the bottom line of this agency theory is that it is a theory that helps to resolve problems between the company executives, or called as the agents, and the principals, called as the shareholders or investors of the company. The second theory that I'm going to discuss is the expectation theory. So what is expectation theory? It attempts to predict what short-term interest rates will be in the future based on the current long-term interest rates. The theory suggests that an investor earns the same interest by investing in two consecutive one-year bond investments versus investing in one two-year bond today. The theory is also known as the unbiased expectations theory. The expectations theory aims to help investors make decisions based upon a forecast of future interest rates. The theory uses long-term rates, typically from government bonds, to forecast the rate for short-term bonds. In theory, long-term rates can be used to indicate where rates of short-term bonds will trade in the future. So how to calculate the expectations theory? So let's say that the present bond market provides investors with a two-year bond that pays an interest rate of 20%, while a one-year bond pays an interest rate of 18%. The expectation theory can be used to forecast the interest rate of a future one-year bond. The first step of the calculation is to add 1 to the two-year bond's interest rate. The result is 1.2. The next step is to square the result, or that is 1.2 times 1.2, that is equal to 1.44. Then divide the result by current one-year interest rate added with 1 and add 1, or that is 1.44 divided by 1.18 plus 1 equals 1.22. To calculate the forecast one-year bond interest rate for the following year, subtract 1 from the result, or that is 1.22 minus 1 equals 0.22, or simply 22%. In this example, the investor is earning an equivalent return to the present interest rate of two-year bond. If the investor chooses to invest in a one-year bond at 18%, the bond yield for the following year's bond would need to increase to 22% for this investment to be advantageous. So what are the disadvantages of expectations theory? So investors should be aware that the expectations theory is not always a reliable tool. A common problem with using the expectations theory is that it sometimes overestimates future short-term rates, making it easy for investors to end up with an inaccurate prediction of a bond's yield curve. Another limitation of the theory is that many factors impact short-term and long-term bond yields. However, long-term yields might be less affected because many other factors impact long-term yields, including inflation and economic growth expectations. As a result, the expectation theory does not consider the outside forces and fundamental macroeconomic factors that drive interest rates and ultimately band yields. So what is the main idea of this expectations theory is that uh, it is a theory that attempts to predict or forecast the short-term interest rate of the investment based on the current long-term interest rate. Okay, so the third theory that I'm going to discuss is what we call the liquidity preference theory. It is a model that suggests that investors should demand a higher interest rate or premium on securities with long-term maturities that carry greater risk because, all other factors being equal, investors prefer cash or other highly liquid holdings. So how does preference theory work? Liquidity preference theory suggests that investors demand progressively higher premiums on medium and long-term securities as opposed to short-term securities. According to the theory, which was developed by John Maynard Keynes in support of his idea that the demand for liquidity holds a speculative power. Liquid investments are easier to cash in full value. Cash is commonly accepted as the most liquid asset. According to the liquidity preference theory, interest rates on short-term securities are lower because investors are not sacrificing liquidity for greater time frames than medium or long-term securities. So, what are the special considerations? Keynes described the theory in terms of three motives that determine the demand for liquidity. The first one is the transaction motives. The transaction motive states that individual prefers liquidity to guarantee having sufficient cash on hand for basic day-to-day needs. In other words, stakeholders have high demand for liquidity to cover short-term obligations, such as buying groceries and paying the rent or mortgage. Higher costs of living mean a higher demand for cash or liquidity to meet those day-to-day needs. So this is to cover daily expenses through cash. The second one is the precautionary motives. The precautionary motives relates to an individual's preference for additional liquidity if an expected problem or cost arises that requires a substantial outlay of cash. These events include unforeseen costs like house or car repairs. This is to use cash for emergency purposes like hospital bills. The third one, we have stakeholders may also have a speculative motive. When interest rates are low, demand for cash is high and they may prefer to hold assets until interest rates rise. The speculative motive refers to an investor's reluctance to tying up investment capital for fear of missing out on a better opportunity in the future. Investors are paid to tie up their investment capital for a longer period because they think that they may miss a better investment ahead. When higher interest rates are offered, investors give up liquidity in exchange for higher rates. As an example, if interest rates are rising and bond prices are falling, an investor may sell their low-paying bonds and buy higher-paying bonds, or hold onto the cash and wait for an even better rate of return. So, example of this is that a 3-year treasury note might pay a 2% interest rate. A 10-year treasury note might pay 4% interest rate, and a 30-year treasury bond might pay a 6% interest rate. For the investor to sacrifice liquidity, they must receive a higher rate of return in exchange for agreeing to have the cash tied up for a longer period of time. So what is the bottom line of this theory? The bottom line is that the long-term investment with greater risk should have higher interest rates because the investors are sacrificing not to hold cash in a longer period. The longer the investment, the higher should the interest rate. Okay, so the fourth theory of financial management is what we call the market segmentation theory. Market segmentation theory is a theory that long and short-term interest rates are not related to each other. It also states that prevailing interest rates for short, intermediate and long-term bonds should be viewed separately in in items in different markets or for the debt securities. I'll repeat. Market segmentation theory states that a long and short-term interest rates are not related to each other. It also states that the prevailing interest rates for short, intermediate, and long-term bonds should be viewed separately like items in different markets for debt securities. Okay, so this theory's major conclusions are that yield curves are determined by supply and demand forces within each market or category for debt securities maturities, and that the yields for one category of maturities cannot be used to predict the yields for a different category or of maturities. Market segmentation theory is also known as the segmented markets theory. It is based on the belief that market for each segment of bond maturities consists mainly of investors who have preference for investing in securities with specific duration, short, intermediate, or long term. Market segmentation theory further asserts that the buyers and sellers who make up the market for short-term securities have different characteristics and motivation than buyers and sellers of intermediate and long-term maturity securities. The theory is partially based on the investment habits of different types of institutional investors, such as banks and insurance companies. Banks generally favor short-term securities, while insurance companies generally favor long-term securities. So, what is the implication of the market segmentation theory in the market analysis? The yield curve is a direct result of the market segmentation theory. Traditionally, the yield curve for bonds is drawn across all maturity length categories, reflecting a yield relationship between short-term and long-term interest rates. However, advocates of the market segmentation theory suggest that examining a traditional yield curve covering all maturity lengths is fruitless endeavor because short-term rates are not predictive of long-term rates. So what is the bottom line of this market segmentation theory? Market segmentation theory states that long-term and short-term interest rates are not related to each other because they have different investors. Thus, the term market segmented theory thus the term market segmented is thus the term sig as thus the term market segmented, since investors in short-term and long-term securities are different in terms of their motivation and characteristics. So this means that the long-term interest rates are different from short-term interest rates because These two different interest rates have different investors. So investors in this long-term and short-term interest rates have different characteristics and motivations. Just like the banks and the banks prefer short-term short-term bond, while the insurance companies prefer long-term bond interest rates. So let's proceed to the fifth theory. We have the preferred habitat theory. The preferred habitat theory is a term structure hypothesis suggesting that different bond investors prefer a particularly maturity length over another, and they are only willing to buy bonds outside of their maturity preference if risk, premium, or premia for other maturity ranges are available. This theory also suggests that if all else is equal, investors prefer to hold short-term bonds in place of long-term bonds, and that is the reason why yields on long-term bonds should be higher than short-term bonds. Okay, so furthermore, securities in debt markets can be categorized into three segments: short-term, intermediate term, and long-term debt. If current interest rates are high, investors expect interest rates to drop in the future. For this reason, the demand for long-term bonds will increase since investors will want to lock in the current prevalent higher rates on their investments. Since bond issuers attempt to borrow fund from the investors at the lowest cost of borrowing possible, they will reduce the supply of these high interest bearing bonds. The increased demand and the decreased supply will push the price for long-term bonds, leading to a decrease in long-term yield. Long-term yield interest rates will therefore be lower than short-term interest rates. The opposite of this phenomenon is theorized when current rates are low and investors expect that rates will increase in the long run. So what is the bottom line of this preferred habitat theory? The bottom line is that the investors prefer to invest in a specific part or habitat of the long-term or yield curve. These are short-term part of the structure of the investment. They are only willing to buy bonds or shift from their habitat or preferred short-term investment structure if and only if the risk premium or premia are available. So when we say preferred habitat theory, the investors prefer only to invest in a specific short-term or short-time investment. They will only buy bonds from other segment if the risk premium is available. But if not, then they will not, because if you shift to another term of investment, the risk might be high depending on the trend of the investment. Okay, so the last theory that I'm going to discuss is the modern portfolio theory. The modern portfolio theory is a practical method for selecting investment in order to maximize their overall returns within an acceptable level of risk. American economist Harry Markowitz pioneered this theory in his paper Portfolio Selection, which was published on Journal of Finance in 1952. He was later awarded a Nobel Prize for his work on modern portfolio theory. A component of a modern portfolio theory is diversification. Diversification means that owning a portfolio of assets from different classes is less risky than holding a portfolio of similar assets. Most investments are either high risk and high return or low risk and low return. Markowitz argued that investors should achieve their best results by choosing an optimal mix of the two based on an assessment of their individual tolerance to risks. So what is really a modern portfolio theory? The modern portfolio theory argues that any given investment's risk and return characteristics should not be viewed alone, but should be evaluated how it affects the overall portfolio's risks and returns. That is, an investor can construct a portfolio of multiple assets that will result in greater returns without a higher level of risk. As an alternative, starting with a desire of a level of expected return, the investor can construct a portfolio with lowest possible risk and is capable of producing that return. So, what is the acceptable risk of modern portfolio theory? The modern portfolio theory assumes that investors are risk averse. They prefer a less risky portfolio to a riskier one for a given level of return. As a practical matter, risk aversion implies that most people should invest in multiple asset classes. The expected return of the portfolio is calculated as the weighted sum of the returns of the individual assets. If a portfolio contains four equally weighted assets with expected returns of 4%, 6%, 10%, and 14%, the portfolio's expected return would be 4% times 25% plus 6% times 25% plus 10% plus 25% plus 14% plus 25%. So each expected return rates should be multiplied with 25% because they are equally weighted assets. So the result of this is 8.5%. So the portfolio's risk is a function of the variances of each asset and the correlation of each pair of assets. To calculate the risk of four asset portfolio, an investor needs each of the four assets variances and the six correlation values, since there are six possible two asset combinations with four assets. So how many correlation we can pair this from 4% paired with 6%, that's 1, 4%, 10%, 2, 4%, 14%, 3, then 6% to 10%, 4, and then 10% and 14%, 5. 1, 2, 3, 4, 5, okay, and then 6, no? Okay, so the modern portfolio theory is a method that can be used by risk-averse investors to construct diversified portfolios and maximize their returns without an acceptable level of risk. So what is the bottom line of this modern portfolio theory? So the bottom line is that this modern portfolio theory helps the investors to invest in different assets to maximize their returns. It is safer to invest into varying assets than investing into similar assets. If you invest in similar assets and then one of these assets falls apart, so the similar ones will follow. This can cause financial loss to the investors. We can associate this with investors who invest in different companies or business firms. So the same case goes with the businessmen who venture in different business initiatives. So when we say modern portfolio theory, this is a compilation of the different investment in different assets. So it would be easier and less risky to if you are an investor, it would be easier for you or less risky for you if you invest in different assets. Or when we say different assets, you invest your money in a different company, varying company. We have for food, agriculture, and then industry, like in music or in any varying industry, because if one of these asset or industry or business might fall, then the other assets will not be affected. because if you will just invest in a certain in the same assets, like all your money are invested into construction company and in construction, and then all if one of this if one of your investment might might fall, then the other similar investment in the same assets will also be affected. So as an investor, you have to invest your money wisely. You have to invest in agriculture, you have to invest in construction, invest in telecommunication, or in food company. So it would be less risky and more advantageous to you as an investor. I guess these are all the six theories, no, the six financial management theory. Thank you for listening, everyone.